Welcome to the Business Book Tube channel. Today I am going to summarize a practical book designed specifically for traders, investors, and anyone navigating financial markets who wants to take control of their emotions and decision-making. Whether you are a beginner or an experienced professional, the challenges of fear, greed, and panic are universal. These emotions can quietly undermine even the best strategies, leading to impulsive decisions, unnecessary losses, and missed opportunities. This audiobook offers a practical, research-backed roadmap to help you understand the psychological forces at play in your trading behavior and to build the tools needed to maintain calm and clarity during volatile market conditions. Drawing on behavioral finance, neuroscience, and real-world examples from professional traders, it breaks down complex concepts into actionable strategies you can implement immediately. 1. Introduction: Why emotions move markets and wreck traders. Markets are, at core, aggregations of human decisions. That means they are not purely rational machines. They are loud, messy, and driven by psychology. That's the good news. If you understand the human element, you can exploit structure in chaos. The bad news: your brain has evolved to protect you from predators, not to optimize PL curves. Fear, greed, and panic are survival responses. They served our ancestors well. In modern markets, they are the reason otherwise competent people sell bottoms, hold losers, and bid euphorically at the top. If you want fewer catastrophic mistakes, you must treat emotional control like a skill, measurable, trainable, and enforced. This book is not a soft pep talk. It is a tactical manual. I'll explain the mechanisms that drive the worst trading errors, show you recognizable case studies, and then give you step-by-step, no-nonsense tools you can apply immediately. If your ego or superstition is in the driver's seat, expect hard feedback. Good traders don't get lucky. They build systems that make luck irrelevant. The emotional core of every trade. Every time you hit buy or sell, two ancient forces are pulling the strings: fear and greed. These emotions are older than civilization. They evolved to keep you alive. Fear to make you run from predators. Greed to make you hoard resources. Unfortunately, financial markets hijack the same circuitry. Fear makes you dump a position at the worst possible time because you're terrified of losing more. Greed makes you hold a winner far beyond reason because you're addicted to the dopamine hit of watching unrealized profits grow. The result? Predictable, repeated errors. Errors you can trace back through centuries of bubbles and crashes. Herd psychology: Why everyone is usually wrong. Humans are social animals. In the wild, staying with the group increased your odds of survival. In markets, it often guarantees mediocrity or ruin. When prices surge, greed convinces you that you're missing out. You follow the herd. When they panic, fear whispers that they must know something you don't. You sell too. Herd behavior is one of the most destructive forces in finance, and it's powered by deeply ingrained emotional reflexes. Take the dot-com bubble of the late 1990s. Rational investors knew that most internet companies had no profits, no business model, and no future. But prices kept rising. People told themselves, this time is different. It wasn't. When the bubble burst, trillions evaporated. What caused the surge wasn't superior analysis. It was FOMO, greed weaponized by herd psychology. Fear's most expensive mistake: selling the bottom. Look back at March 2020. COVID-19 headlines triggered panic. Stocks collapsed in the fastest bear market in history. What did most retail traders do? They sold. They couldn't handle the bleeding red in their accounts. The fear was physical: sweaty palms, racing heart, sleepless nights. And then, just weeks later, the same market reversed violently upward. Those who sold in panic locked in catastrophic losses. Those who had rules, discipline, and patience came out stronger. The painful truth is fear doesn't care about fundamentals. It doesn't care about central bank policy or corporate earnings. It cares only about survival. Your brain sees a falling portfolio and thinks, danger. It screams, get out now. And unless you have systems in place, you will obey that voice. Greed's silent trap. The "this time I'm a genius" syndrome. Greed doesn't feel like a problem while it's happening. It feels like confidence, momentum, brilliance. You nailed a few trades. You doubled your account in a bull run. Suddenly, you believe you've mastered the game. That's when you size up too aggressively, abandon your stop losses, and overexpose yourself to one trade or sector. Consider the Bitcoin rally of 2021. Traders who entered early saw astronomical gains. Many believed they were financial prodigies. Few took profits. Most ignored basic risk management. When the inevitable correction hit, billions in paper wealth vanished. They weren't unlucky. They were greedy and overconfident. Why rational analysis fails under stress. Here's what most textbooks won't tell you. Your prefrontal cortex, the rational, analytical part of your brain, goes offline under acute stress. In loss situations, the amygdala hijacks your thinking, narrowing focus to immediate threats. Dopamine-driven reward circuits make future profits seem more certain than they are. That's why you make decisions in a panic you'd never make in calm conditions. It's why you buy garbage at the top and dump quality assets at the bottom. Unless you accept that your brain will betray you, you have no chance of overcoming it. Emotional mastery equals market edge. Most traders obsess over strategies, indicators, and news feeds. But ask any consistently profitable trader, and they'll tell you the same thing. The real edge isn't a system, it's self-control. The amateur thinks the goal is to eliminate emotion. The professional knows the goal is to design a process that makes emotion irrelevant. This is the foundation of behavioral finance. It's not about suppressing feelings. You can't. It's about understanding how they work and building structures that keep them from dictating your decisions. The first rule, respect the enemy inside. If you take one lesson from this chapter, make it this. The market is not your opponent. You are. Every panic sell, every over-leveraged position, every revenge trade, those weren't caused by the Fed or an algorithm. They were caused by you losing control of your psychology. Until you accept that, you'll stay stuck in the same cycle. Euphoria, overconfidence, greed, excessive risk, fear, panic, loss, regret. Breaking that cycle starts with brutal honesty. You're not a rational investor. You're a human animal with primitive software trying to operate in a high-stakes, data-rich environment. Your survival instincts are miscalibrated for this game. But once you know that, you can do something about it. Chapter 1 Takeaways. Markets move because of emotion, not logic. Fear and greed are survival tools, misfiring in a financial environment. Herd behavior amplifies bubbles and crashes. Under stress, your rational brain literally shuts down. The first edge is self-awareness. Understand your emotional triggers before you try to outsmart the market. Chapter 2. The biology of fear and greed. What happens in your brain when money's on the line? If you don't understand what your brain is doing during a trade, you're trading blind. Most retail traders think discipline is about trying harder or being more logical. That's a rookie mistake. When thousands of dollars are on the line and the chart suddenly goes vertical against you, willpower is worthless. Your biology takes over, and it doesn't care about your strategy. To master emotion, you must first understand the machine you're operating. And that machine, your brain, was not built for markets. 1. The amygdala, your internal alarm bell. The amygdala is a small, almond-shaped structure deep in the limbic system, and it's the reason you feel fear before you even understand why. Its job is survival, detect threats, trigger a fight or flight response, and flood your body with chemicals to act fast. In trading, the amygdala doesn't distinguish between a bear charging at you and a red candlestick plunging through your stop loss. Both feel like existential threats. Heart rate spikes, Adrenaline floods your bloodstream. Focus narrows to the immediate danger. This is why when markets crash, people sell indiscriminately. It's not a rational calculation, it's a biological reflex. And once your amygdala is driving the bus, your prefrontal cortex, the part responsible for analysis and planning, is shoved into the back seat. 2. The prefrontal cortex, your inner risk manager that shuts down under stress. The prefrontal cortex is the logical, deliberate, analytical part of your brain. It's what makes calculations risk-reward ratios, analyzes balance sheets, and builds strategies. Unfortunately, it's also slow, and under intense stress, the amygdala hijacks the system and overrides it. This means the very part of your brain that makes you a good trader is the first to go offline when things get intense. Here's a classic example. During the 2008 financial crisis, traders who had carefully built long-term strategies abandoned them overnight. Their plans didn't suddenly stop working. Their prefrontal cortex did. They weren't deciding to sell at the bottom. Their biology was. 3. Dopamine, the fuel of greed and overconfidence. If fear is driven by the amygdala, greed is powered by dopamine, the neurotransmitter of anticipation and reward. Dopamine spikes before you make money, not after. It's the surge of excitement you feel when a trade is working and you imagine the profit you're about to make. The problem? Dopamine rewires behavior. It tells your brain, do more of what led to this reward. Closed a quick profit? You start chasing more trades. Doubled your account? You start oversizing positions. Missed a breakout? You feel physical discomfort and FOMO. This is why traders hold losers too long, like it'll come back, and ride winners into reversals, like just a bit more profit. Dopamine clouds judgment by making gains feel inevitable and risk feel distant. 4. Cortisol and the feedback loop of panic. Cortisol, the body's main stress hormone, plays a different but equally dangerous role. When your portfolio plunges, cortisol surges, increasing anxiety, sharpening fear responses, and often causing analysis paralysis. You freeze, unable to act, watching losses mount. This creates a deadly feedback loop. Portfolio drops, cortisol spikes, panic grows. Panic to impulsive action, like selling at the worst time. Impulsive action to regret, to more stress. This physiological cycle destroys accounts not because traders don't know better, but because they're chemically incapable of making rational decisions in the heat of the moment. 5. Evolutionary hardware, modern game. Remember, your brain was designed for a world where threats were physical and immediate, predators, starvation, rival tribes. In that environment, reacting instantly to danger increased your odds of survival. In the market, this wiring backfires. Fight response, revenge trading after a loss, doubling down to win it back. Flight response, panic selling positions during volatility, even when fundamentals are intact. Freeze response, doing nothing as losses spiral, hoping the problem disappears. Your instincts are ancient. The market is modern. That mismatch is why most traders fail. 6. The hot state versus cold state trap. Psychologists talk about hot states and cold states. In a cold state, calm, analytical, detached, you plan well. You build sound strategies, set sensible stop losses, and swear you'll follow your rules. But once money is on the line and your heart is pounding, you enter a hot state. In this state, the emotional brain overrides the rational brain. Plans made in cold states are ignored in hot ones. This is why traders break every rule they swore they'd follow once volatility spikes. Recognizing this gap is crucial. Smart traders don't rely on willpower in hot states. They design systems in cold states that don't allow impulsive actions later. 7. Why awareness is the first line of defense. You can't remove these biological reactions. They're hardwired, but you can blunt their impact. The first step is awareness. When you notice physical symptoms, racing pulse, tight chest, impatience, euphoria, that's your body telling you emotion is taking over. Here's what pros do. Name the state. I'm in fight mode, or this is dopamine talking. Naming it reduces its power. Pause before acting. A 60-second breathing reset can lower amygdala activation and restore prefrontal cortex control. Pre-commitment. Rules set in cold states like automatic stop losses or trade size caps prevent hot state decisions. 8. Real-world example. The flash crash and biological hijack. On May 6, 2010, the Dow Jones plunged nearly 1,000 points in minutes. Most of the selling wasn't driven by fundamentals, it was panic. Retail traders watching the free fall felt a visceral sense of danger and bailed at any price. But the drop was short-lived. Within minutes, prices recovered. Those who acted on biology sold near the bottom. Those who stuck to preset rules or recognized the emotion and paused were rewarded. The event was a brutal but clear lesson. In high-speed markets, biology is your biggest liability. Final thoughts. Master the machine. Your brain isn't broken. It's just miscalibrated for trading. Fear, greed, panic, they're all ancient survival responses playing out in a context they weren't designed for. The key isn't to suppress them, you can't, but to understand them so well that they no longer control your behavior. The traders who survive and thrive aren't the smartest or fastest. They're the ones who design systems to protect themselves from themselves. That starts with knowing exactly what's happening in your head when the stakes are high. Key takeaways from Chapter 2. The amygdala drives fear and overrides rational thought under stress. Dopamine fuels greed and overconfidence, pushing you to chase profits. Cortisol locks you into cycles of panic and bad decisions. Your brain evolved for physical survival, not financial risk. Awareness and pre-commitment are your best tools against biological sabotage.
Chapter 3. The Twin Forces. Fear and Greed as Market Engines. If markets were purely rational, prices would only move on fundamentals, earnings, interest rates, and macroeconomic data. But every experienced trader knows that's a fantasy. What truly drives short-term price action is not information, it's emotion. And at the core of that emotional engine are two primal forces, fear and greed. They are the yin and yang of the financial world, opposite yet inseparable, destructive yet necessary. Understanding them is not a luxury. It's the difference between being a disciplined investor and a panicked speculator. 3.1. Greed, the illusion of infinite profit. Greed is seductive. It whispers in your ear, hold a little longer, double down. This time is different. It's not evil, it's human nature. But when unchecked, greed distorts your risk perception and blinds you to reality. Classic manifestations of greed in trading. Overtrading. You jump into every setup fearing you'll miss the next big one. Ignoring exit signals. You refuse to take profits because you want just a little more. Risk escalation. You increase position sizes aggressively after a few wins, believing you're on a hot streak. Case study: the Bitcoin Mania, 2017. During the crypto boom, Bitcoin soared from under $1,000 to nearly $20,000. Many early investors could have secured life-changing profits, but greed made them believe $100,000 was inevitable. Most of them not only failed to sell, but also bought more at the top. Within months, the price crashed by over 80%. Greed convinces you that exponential returns are your destiny. But in reality, it blinds you to risk, clouds your judgment, and turns potential profits into painful losses. 3.2. Fear, the paralyzer and the panic button. If greed pushes you to chase gains, fear does the opposite. It freezes you in place, or drives you to exit prematurely. Fear is deeply wired into your biology. It's a survival mechanism. But in the market, survival instincts often sabotage rational decision-making. Typical fear-driven behaviors are selling too early. You exit a trade at the first sign of volatility, missing the larger trend. Avoiding good setups. You don't enter trades because the memory of past losses still haunts you. Capitulation. You sell at the very bottom during the crash, locking in massive losses. Example: March 2020 market crash. When COVID-19 hit, global markets collapsed over 30% in weeks. Many investors, terrified of a total collapse, sold everything at the bottom. Those who stayed calm or even bought more saw markets recover to new highs within months. Fear made many lock in catastrophic losses, while patient investors multiplied their wealth. Fear is useful when it signals legitimate risk, but most of the time in trading, it's exaggerated, a leftover survival response from a primitive brain that can't distinguish between a bear market and a bear in the woods. 3.4. The fear-greed cycle. Why markets swing from euphoria to panic. Markets are collective psychology in motion. When greed dominates, prices rise beyond fundamentals. When fear takes over, they collapse below intrinsic value. This oscillation is not a flaw. It's the heartbeat of the market. Be fearful when others are greedy, and greedy when others are fearful. This timeless quote captures the essence of contrarian investing. The best opportunities often arise when the crowd is emotionally extreme. Yet most traders do the exact opposite, buying tops and selling bottoms, because they're unconsciously swept into the collective emotional tide. Typical market cycle phases are optimism to euphoria, greed inflates bubbles; anxiety to fear, early cracks appear but most ignore them; panic to capitulation, fear dominates, prices collapse; despair to hope, smart money enters quietly while the crowd hides. Recognizing where you and the crowd are in this cycle gives you a powerful psychological edge. 3.5. Building emotional awareness, your first line of defense. You cannot eliminate fear and greed, but you can recognize and regulate them. Awareness is the first step towards mastery. Practical techniques to manage these forces. Pre-commitment. Define your entry, stop-loss, and exit before entering a trade. Emotion thrives in ambiguity. Emotional journaling. Record your thoughts and feelings before, during, and after trades. Patterns will emerge. Pause reaction. When a strong emotional impulse hits to buy or sell, pause for 5 minutes and reassess the facts. Position sizing. Never risk so much that a single trade can trigger panic. Control position size and you control fear. Mastery mindset. Becoming the observer. The greatest traders aren't emotionless robots. They're deeply aware humans who don't identify with their emotions. They observe fear and greed rising and falling without letting them dictate behavior. When you learn to step back and think, that's greed talking, or this is fear trying to protect me, you regain control. And control, not prediction, is the real edge in trading. Key takeaway. Fear and greed are not enemies to be destroyed. They're forces to be understood and managed. Master traders don't fight them. They design systems, rules, and mental frameworks that keep their decisions grounded in logic as even the market's emotional waves crash around them.
Chapter 4. Common behavioral biases that turn volatility into mistakes. Market volatility, characterized by rapid and unpredictable price swings, is an inherent and inevitable feature of all financial environments. By itself, volatility is simply data. It is neutral, reflecting the continuous process of price discovery as new information is digested by the collective market. Yet, for many participants, volatility does not feel neutral. It feels like stress, fear, or opportunity, often leading to decisions that are detrimental to long-term performance. The transformation of this neutral data into costly, painful mistakes is not due to a failure in analysis or research, but a fundamental failure in human psychology. It's the predictable intrusion of ingrained behavioral biases, short, ugly, and unavoidable, that sabotage rational decision-making and turn market movements into personal disasters. The most successful traders and investors do not eliminate these biases. They install robust defensive systems designed to neutralize them entirely. Loss aversion and the disposition effect. Perhaps the most potent and destructive bias is loss aversion, which is mathematically simple but psychologically crippling. The pain of realizing a loss is roughly twice as powerful as the pleasure of realizing an equivalent gain. This bias fuels the disposition effect, the observable phenomenon that traders tend to sell winners too early and hold losers too long. When a position rises, the immediate gratification of locking in a profit, selling a winner, feels satisfying, even if the position still has considerable upside potential. The trader trades small gains for the relief of having captured something. Conversely, when a position drops, the act of selling forces the recognition of loss, triggering intense emotional discomfort. To avoid this pain, the trader rationalizes holding on to the losing stock, often hoping for a rebound merely to reach the break-even point. This action is purely psychological. The money is gone. The result is a portfolio skewed toward underperformers, holding sinking ships while prematurely selling the ones that could have soared higher. This behavior ensures net worse performance and is the classic outcome of allowing pain avoidance to dictate portfolio management during stressful downturns. The arrogance of overconfidence. While fear drives loss aversion, success often breeds overconfidence. After a sustained period of successful trades or a sequence of quick wins, a feeling of invincibility can creep into a trader's mind. This psychological state severely impairs risk management. The individual begins to believe their success is due to unique skill rather than market conditions, luck, or their existing disciplined system. As a result, position sizes creep up, leverage may be increased, and essential checks like setting stop-loss orders or performing proper due diligence go out the window. Volatility, when encountered by the overconfident trader, is met with aggressive defiance rather than cautious respect. Overconfidence encourages traders to take outsized risks on what they perceive as sure things, leading to one swift, large loss that can easily wipe out months or even years of accumulated small gains. In the trading world, confidence is necessary, but overconfidence kills. The comfort of the crowd, herding and confirmation bias. When volatility spikes, people naturally look for external validation, leading to two intertwined biases: herding or social proof, and confirmation bias. Herding is the tendency to follow the actions of a large group, believing that if everyone's buying or selling, their collective action must be justified. This is not a strategy. It's a deeply rooted survival mechanism, using others as a shortcut to decision-making, that becomes disastrous in financial markets. Herding behavior is the fuel that transforms a steady rally into an irrational bubble and a healthy correction into a panic-driven crash. People buy not because the fundamentals are sound, but because they fear missing out on a perceived easy profit, or they sell simply because they fear being the last one holding the bag. This meanwhile ensures that the trader only searches for news or analysis that supports their existing thesis. During market turbulence, an investor who owns a stock and watches it decline will desperately seek articles, tweets, or analyst notes that rationalize the decline as a temporary blip rather than engaging in objective reevaluation. This is less about research and more about self-administered therapy. This bias creates an intellectual echo chamber, blinding the investor to critical information that might signal the necessity of cutting losses or reducing exposure, making them vulnerable to deeper drawdowns during prolonged volatile periods. The shackles of irrelevant metrics. Anchoring and the sunk cost fallacy, two distinct but equally damaging biases, chain traders to past irrelevant data. Anchoring occurs when a trader fixes their attention on an arbitrary price point, such as their original entry price, a previous high, or a round number. Then they make current decisions relative to this outdated metric. For example, a trader refuses to sell a stock at a loss because they are anchored to their purchase price, even though the company's fundamentals have permanently deteriorated. Alternatively, they may refuse to buy a great stock because it is too high compared to where it traded 6 months ago, foregoing future gains due to a fixation on a cheaper yet irrelevant historical price. The sunk cost fallacy provides the emotional rationalization for anchoring. I've invested too much time and money, so I must continue. The money already spent, the sunk cost, is completely irrelevant to the profitability of the future decision. Volatility often exposes the flaws in initial investment decisions, but the sunk cost fallacy traps the investor, compelling them to double down on a losing venture simply to validate the previous expenditure. Both biases prevent the necessary objective assessment of current market information, leading to paralysis when decisive action, buying, selling, or trimming, is required. The illusion of permanence. Recency bias. Finally, recency bias causes traders to overweight the latest, most vivid data, assuming that recent volatility or trends will persist indefinitely. Following a sharp 3-day rally, the recency bias suggests the market can only go up, encouraging aggressive buying at the top. Conversely, after a period of steep decline, the conviction that a recovery is impossible sets in, leading to panic selling at the bottom. The core mistake here is confusing short-term noise with long-term trend. Volatility is, by definition, transient, yet recency bias makes recent market activity feel permanent, causing overreaction and the disastrous chasing of performance, often buying high and selling low. Installing the fences. Every one of these behavioral tendencies is a predictable and systemic failure point in the human trading psyche. The collective effect of these biases is that volatility, which should present opportunities for systematic, risk-managed adjustments, instead triggers an avalanche of emotional, mistake-ridden actions. The antidote is not found in sheer willpower, but in systemization. The most effective defense against the self-sabotage of behavioral biases is the adherence to a predefined set of rules, a trading plan or investment policy. Rules surrounding position sizing, stop-loss triggers, portfolio rebalancing, and entry and exit criteria act as an external circuit breaker, neutralizing the emotional impulse to hold, herd, or overcommit. By committing to a system before market stress begins, traders successfully depersonalize volatility and ensure that decisions are based on objective criteria, not on the fear, arrogance, or fixation of the moment. Chapter 5. Panic and market crashes. Staying rational in chaos. When markets crash, the charts stop being about numbers, they become mirrors reflecting human terror. Prices collapse not because fundamentals suddenly evaporate overnight, but because millions of people all at once decide to panic. And when fear spreads fast enough, it becomes contagious. That's how corrections turn into crashes, not from information, but from emotion running unchecked. If greed makes traders overstay their welcome, panic makes them run before they've even been hit. The best investors in history, from Buffett to Dalio, didn't build fortunes by predicting crashes. They did it by staying calm when everyone else lost their minds. Real traders react the same way across crises. They panic, and the best of them don't. 5.1. Panic, when the primitive brain takes control. Panic isn't just fear, it's fear amplified beyond reason. Neuroscience shows that during financial stress, the amygdala, the ancient fight or flight part of the brain, hijacks decision-making from the prefrontal cortex, the rational part. This means that in a market crash, you're often not thinking at all, you're reacting. Common panic behaviors include instant liquidation, selling everything without evaluating actual risk; information overload, obsessively checking news and charts every 5 minutes, amplifying anxiety; following the herd, copying what others are doing even when it contradicts your strategy. 2008, Lehman and the credit squeeze. When Lehman collapsed, credit markets froze. Overnight funding disappeared. Traders and funds who depended on leverage faced margin calls. The psychological effect? The world felt suddenly smaller and more dangerous. Many institutions were forced into fire sales. If you were long illiquid assets and levered, you were trapped. Lesson: leverage plus illiquidity plus panic equals ruin. Black Monday, 1987. A historical precedent where price action created feedback loops among program traders. Panic was mechanical as much as emotional. Once selling begins, systems and humans amplify the fall. Lesson: Know what will force you to sell before a crisis starts. March 2020, COVID crash. The speed of the drop shocked even veteran traders. Volatility spiked and liquidity evaporated in corners of the market. ETFs, corporate bonds. Traders who had plans, predefined hedges, rules for cash, position sizing survived better. Those improvising compounded losses. These are not ancient myths. They're patterns. Fear causes selling, which causes prices to fall further, which creates more fear. Your job is to interrupt the cycle for yourself. 5.2. Framework for staying rational during a crash. You cannot control the market, but you can control your reaction. Professionals don't feel less fear. They design systems to act rationally despite it. Here's the framework they follow. 1. Predefine your rules before the storm. Set your exit points, stop losses, and position sizes in advance. Decisions made during panic are 90% emotional. Decisions made before panic are 90% logical. 2. Zoom out the time horizon. Crashes look catastrophic on a one-day chart. On a 10-year chart, they're tiny dips. Reframing time is one of the most powerful psychological tools you have. 3. Turn off the noise. In a crisis, financial media thrives on fear. Doom headlines get clicks. Your job isn't to consume panic, it's to filter for data that matters. Sometimes the smartest move is to close the news tab entirely. 4. Use position sizing as an emotional buffer. Never risk so much that a crash wipes you out. Professional-size positions so that even a 50% drawdown is survivable. When you know you can't be ruined, fear loses its grip. 5. Automate discipline with stop losses and triggers. Let software execute your risk plan. Human hands panic sell. Algorithms follow rules. 5.3. The contrarian's edge, seeing opportunity in panic. While the average investor sells into fear, the elite few quietly accumulate assets at fire sale prices. It's not bravery, it's preparation. They know the math. Panic is temporary, but value is permanent. Example, Warren Buffett in 2008. While most investors were dumping shares, Buffett injected billions into companies like Goldman Sachs and General Electric at bargain valuations. A decade later, those positions generated enormous returns, not because Buffett predicted the crash, but because he was ready to act when everyone else froze. Contrarian investing isn't about buying the dip blindly. It's about recognizing when fear has pushed prices far below intrinsic value and having the courage and liquidity to step in. 5.4. The emotional checklist for market chaos. When volatility spikes and your heart rate follows, run through this checklist before taking action. Am I reacting or responding? Panic is reaction. Logic is response. Has the fundamental thesis changed? If not, why am I selling? What would I advise a friend to do in my place? Externalizing the decision often removes emotion. Will this matter in 5 years? If the answer is no, your fear is probably noise. Is this opportunity hiding in plain sight? Crashes hide the best entries. 5.5. Mindset shift from fear of loss to love of opportunity. The most powerful transformation a trader can make is shifting their perspective. Instead of seeing a crash as destruction, see it as reset. Fear sees falling prices and imagines ruin. Mastery sees falling prices and imagines possibility. Because the truth is this: every great fortune in history was built during a panic. Crashes end, recoveries begin. The only question is whether you'll still be standing and ready when they do. Key takeaway: panic is inevitable, but panic selling is optional. Crashes are not financial events, they are psychological events.
If you can manage your emotions when others can't, you don't just survive bear markets, you exploit them. Chapter 6. Real Market Case Studies, Learning from Emotional Mistakes and Successes. The best lessons in trading aren't in textbooks or indicators, they're in real market behavior. Every crash, rally, or volatile session carries a story of emotion-driven decisions. By analyzing these events, you can see exactly how fear and greed manifest and how emotional mastery creates consistent winners. 6.1. The dot-com bubble, 1999 to 2000. Greed ignites a frenzy. The late 1990s were a period of extraordinary optimism. Internet companies without profits or business models were doubling or tripling in value daily. Retail investors, fueled by greed and media hype, poured capital into anything with .com in the name. Emotional traps observed. A fear of missing out. Many investors bought at all-time highs, convinced that the surge would continue indefinitely. Confirmation bias. People ignored negative signals, financials, valuations, or fundamental risk because the market felt unstoppable. Overconfidence. Short-term wins reinforced the illusion of skill, leading to overexposure. Outcome. The bubble burst in 2000. Investors who followed emotion lost enormous capital, while those who maintained predefined rules, diversified portfolios, and rational entry points weathered the storm. The takeaway? Greed without discipline is destructive, while systems safeguard capital even in mania. 6.2. The 2008 financial crisis. Panic overrides logic. The collapse of Lehman Brothers triggered one of the most severe financial panics in history. Markets plummeted over 50% globally in months. Retail investors, caught in the wave of fear, liquidated positions indiscriminately. Emotional traps observed. Herd mentality. Investors sold because others were selling, not based on fundamentals. Loss aversion. The pain of losing outweighed rational calculation. Even good companies were dumped. Contrast with masters. Institutional traders with liquidity and pre-committed strategies bought during panic. Warren Buffett's injection into companies like Goldman Sachs is a textbook example. He exploited widespread fear while others capitulated. By observing the crowd's emotional behavior and following a disciplined system, he profited enormously. Lesson? Panic is predictable. The market often overreacts. Emotional mastery allows you to act logically when others are irrational. 6.3. COVID-19 Crash, 2020. Volatility amplifies emotion. In March 2020, the S&P 500 dropped over 30% in less than a month. The speed of the crash tested every trader's emotional resilience. Many retail investors reacted impulsively, selling high-quality stocks at fire sale prices. Emotional traps observed. Acute fear response. Physical symptoms of stress, sweating, rapid heartbeat, sleeplessness drove rash decisions. Overexposure panic. Investors holding concentrated positions felt extreme vulnerability and exited completely. Success stories. Those who adhered to predefined risk management, automated stop losses, and journaling protocols avoided catastrophic losses. Traders who paused, reviewed fundamentals, and looked for opportunity entered positions at historically low valuations, capturing the rebound within months. Lesson? Emotional awareness and pre-commitment outperform raw instinct even in unprecedented crises. 6.4. GameStop and meme stock mania, 2021. Herding meets overconfidence. The GameStop short squeeze was a modern example of emotion-driven volatility amplified by social media. Retail investors, motivated by greed, FOMO, and the thrill of being against the hedge funds, created massive, rapid price swings. Emotional traps observed. Speculative greed. Many bought without understanding underlying fundamentals. Euphoric overconfidence. Short-term gains were mistaken for skill. Crowd influence. Buying and holding decisions were driven by community sentiment rather than analysis. Outcome: those caught at the peak experienced rapid losses when the frenzy collapsed. Traders with rules-based entry, exit, and position sizing either avoided the chaos entirely or used it as a strategic short-term arbitrage opportunity. Lesson: even in extreme social-driven volatility, disciplined emotional management separates surviving traders from casualties. 6.5. Key patterns across crises. Analyzing these events reveal recurring emotional patterns. 1. Greed peaks at market tops. Buying in euphoric conditions often leads to catastrophic risk. 2. Fear peaks at market bottoms. Panic selling creates bargain opportunities, but only if controlled. 3. Herd behavior amplifies volatility. Following the crowd is almost always detrimental. 4. Emotion-driven decisions outweigh fundamentals. Rational analysis rarely prevents losses during high-stress periods. Takeaway: markets are not inherently unpredictable.
Human emotional reactions are. By studying past crises, you can predict common behaviors and plan systems to exploit or avoid them. 6.6. Applying emotional mastery to real decisions. The key is not avoiding emotion. It's structuring your process so emotion cannot override logic. This includes pre-committed systems, stop losses, risk limits, and profit targets. Journaling. Record emotional triggers and market reactions for continuous learning. Contrarian thinking. Question the crowd's actions. Are they driven by emotion or fundamentals? Mindset training. See fear and greed as data, not directives. Practical exercise. After reading these case studies, write down 3 past trades where fear or greed influenced your decisions. For each, design a rule or pre-commitment that would have prevented the error. This transforms experience into a mechanical advantage. 6.7. The ultimate insight. Markets will always evoke emotion. Crashes, bubbles, and rallies are psychological as much as financial. Traders who survive and thrive are those who recognize emotional patterns, prepare systems to neutralize them, apply lessons from historical behavior, and respond logically, not reactively. Mastering this is what turns trading from a roller coaster of panic and regret into a disciplined, profitable practice. Your brain will always generate fear and greed. The edge comes from controlling the consequences, not the emotion itself. Key takeaways, Chapter 6. Fear and greed follow predictable patterns in all market crises. Herd behavior amplifies both profits and losses. Pre-committed systems and emotional awareness outperform raw instinct. Learning from historical examples builds the mental framework to act rationally in chaos. Emotional mastery transforms crises into opportunity, not disaster.